Good afternoon and welcome to Revenue-Based Finance with founder of Tractor Ventures, if you can't tell by his t-shirt, Matt Allen. Before we get started, I'd like to acknowledge the traditional owners on the land of which we meet. I understand that will be different for all of us, but for me, that's the Gubbi Gubbi people. And I pay my respects to their elders past, present and emerging. Now, we have a wonderful lunch hour for you today. And if you happen to be in Melbourne, there's an evening to follow if you're interested, which Matt can talk you through. But you haven't joined to talk to me. I'll pass over to Matt.
Thanks so much, Charlotte and Nick, for having me and the team. So I'm here to talk to you today about some different ways you can get capital into your business. So I might just kick this off. 2 seconds.
While you're doing that, Matt, I'll just launch a poll to see what stage people are at.
Great.
I can just go in the background.
Very cool. All right. So I've got this. Right. So this is why we exist. We exist to provide options and leverage for founders so you can retain as much of your company for as long as you like. We are certainly not anti-venture capital. We are anti-unnecessary dilution. So what does that mean? It means that not all founders want or need venture capital. A bunch of them will go off and build rockets, but we think there's a bunch who will also build tractors. And just a little bit on why we call our tractors. After I finish up my time at Amazon, the end of 2019, sorry. I'd met so many founders as part of my job on the startup venture capital team. And it always annoyed me that we use this term unicorn in startup land. I always wondered whether the people in real business would take us seriously if we were talking about unicorns all day long, given they don't exist and they're quite childish. So I wrote a memo called Rockets vs. Tractors, and the analogy I think is a little more apt. The reason I think it's a bit more apt is if the VCs fuel up the rockets, they require a lot of fuel. They're quite expensive to build. They're quite complicated. They're hard to fly. They're prone to blowing up, and they're very difficult to land, which I think is kind of the definition of the kind of thing you need to be building for the VCs to get excited. On the other hand, we have tractors, and tractors are usually consistent and reliable. They do a job and they do it well. And if you tell a farmer, take their tractor off them, they're likely to be quite upset because it's really important for them to rely on that to get the job done. And, the stats out there around, the number of companies that get VC backed, the number of tech companies that get VC backed is probably 1.5%, which tells me there's 99 other, no, for every one that gets done, there's 99 others that don't get venture capital. I'd probably argue that maybe 80 or 90% of them are not backable by any type of capital at that particular point in time. They're too early or they haven't quite got it together. But we believe that the 9 or 10% on top of that 1% are building really great businesses. That's what we do at Tractor. And it's interesting, this is a little bit old, but there's a lot of capital out there going into tech companies. But interestingly enough, debt in Australia for tech companies is a fairly new proposition. Most of the dollars here, and I know I've got some friends that run, these debt companies, and Tractor is one of them, that are able to lend into tech companies. Probably less than 1 or 2% of all the capital out there is debt at the moment in Australia, where in America, it's actually around 25%. So when people talk about the VC industry in the States, about 20 to 25% of it is debt, and the rest of it is equity. So in a much more mature ecosystem that's been through the ringer a few times, most founders are using debt to help them grow their businesses without selling their shares. So we focus entirely on tech businesses or tech-enabled businesses, which usually have high margins. And the way I describe that is it's a business where the revenue and the costs can decouple themselves. So, A services business, for instance, is not one of those things. Hairdressers, fish and chip shops where they have constraints where they can only be a certain size is not what we do. What we end up doing is, or what we've done is we've built IP and tech to credit and risk score non-tangible asset businesses with recurring revenue. And the reason that's important is because the banks don't know how to do that. Any bank that would ever lend you a loan would look backwards and how your business has gone until today. It'd have to be profitable, and they'd have to, a lot of the time, secure it against something they can go and touch. That's not what we do, and we believe that recurring growing revenue is an asset, and we're able to run that through our processes, take a position on its likelihood of continuing to do that, and then lend against it. So Tractor itself is funded, but not by VC, and we'll never ever take VC onto our cap table. So we have a bunch of current founders, ex-founders, and family offices who have funded us. And the reason they've funded us is I've been around for a little while. My background has been, for the first half of my career, I was a software developer, a CTO, and a technical co-founder. About halfway through, around 2013, I shifted gears and became post-technical. I ran a technical recruiting company, and I built out the software engineering teams, things like realestate.com.au and Redbubble and REA and Domain and all the scale-ups. After that, I joined the AWS team on the start of a venture capital team, which was a global team, which was an excellent way to me to help a lot of founders. But also in parallel with starting my tech recruiting company, which just also happened to be very lucrative, I started investing in tech companies as well. So April, my wife, you can see here on the top row there on the right-hand side, and I have about 50 angel investments over the last decade, of which we've exited several of them. We've taken secondaries out of several of them, and the portfolio's performing fairly well overall. So when we did go start Tractor, a bunch of those founders that I'd invested in, April and I invested in, became investors in Tractor, which was nice. And a lot of the family offices that we co-invested in along the way had come in and backed us as well. So the important thing to note about our investors is there's no one who's a shareholder in Tractor that has a time-bound investment vehicle. So nobody's going to call me in 5 years' time and say, hey, we've got to shut this fund down. We need our money back, which is important because it flows into how we run our businesses. And you can see here some logos that you'll probably recognize of some people that are on the cap table of Tractor. So how do we do it? What do we do? What is this revenue-based finance? RBF is the acronym we use. The best way to think about it, as I said, is a loan against your future revenue. So we allow you to pull some of that forwards and then pay it back via a top-line revenue share. So as your revenue grows, it's a fixed percentage, but a variable payment every month. And we've built a platform that allows you to, on the 7th of every month, if you had a loan with us, the 7th of the next month, we'll pull data out of your Xero, confirm that that was your revenue. You confirm it, we direct debit it on the 21st of the month. And that's what we do every month. Up front, we agree how much capital you want, how much we're going to get returned. So it's a fixed return with a variable amount of time. The faster you grow, the quicker it comes back, but it's also because you're growing very quickly. Conversely, if it takes you longer to get to where you thought you're going to get, it takes longer to come back to us, and that's our risk. So we take your forecasts, your current trajectory plus your forecast into account, do some modeling on it, spit out a loan that we think is probably going to take a couple of years to come back. So usually the amount of capital is somewhere between 2 and 4 times your monthly revenue is the amount we could loan you. And it'll come back somewhere between 1.2 and 2 times that over the next couple of years via that top line revenue share. So we don't talk about interest rates because it's very hard to engineer, but think about it as a credit card like, but it's entirely unsecured via personal guarantees or anything like that. The asset we look at is revenue, and that's it. So it's really important that what that means is it creates that freedom for founders. We believe founders can run their business in one of 3 ways. They can run a profitable business if they really want to, which is great. If you decide to go and raise capital, that also works for us. That's fine. And if you want to sell it, that's also fine as well. And our business model does not dictate how you run your business, which was why we built Tractor in the first place. I wanted founders to have the optionality to do whatever they want. There's a little bit of a thought process out there, maybe, that's you either, if you get venture back, if you're venture back, then you're important. And if you're not, you're not. And we just don't believe that's true. We don't believe that venture is the only way to grow a big, impactful, important business. We believe that founders can do this any way they want. And there's multiple different paths to do that. In fact, I've got people, shareholders in my company that were rejected by VC, and then sold their company for hundreds of millions of dollars, and they own the whole damn lot. In fact, they were introduced me from Nicky from Blackbird, said several of my shareholders who he said no to, then they went off and sold them literally for hundreds of millions of dollars and own the whole damn lot. So, I think it's really important that founders understand that every dollar that you take from somebody else to put into your business has an expectation attached to it on when they get their money back and how much. And the thing about venture capital is that, it'll change from a seed or a really early investor up to a late stage investor, but on average, they'd expect 50% compounding interest on the money they've given you by the time they sell their shares at the end. That's where it's at. It's higher for the really early investors and a little lower for the late stage investors. But that money is not free. That money costs you, the founder, the delta between what you gave them as a percentage of your company. Now, it's really important to know that that for a lot of companies, having equity partners who are on that 7 to 12 year journey with you is really important, because especially when you're building companies that require a very heavy capital investment up front, that you don't want to be paying interest on that money if there's going to be it's going to take ages for it to start returning. So part of what we do at Tractor, sometimes I say we're a financial education company with a $20 million fund behind us that we need to deploy over the next 12 months. And the reason we're in that is that tech companies up until recently have used the same dollar to do all the jobs inside their business, and to get that dollar they've sold shares. But as your company grows, there's different parts of your business that run at different paces, and they have different return on investment. So we talk about our capital as being mid-term capital, so that couple of years it takes to return. So if I sold you $1 for $1.30 and you paid it back to me over 2 years, but you had a machine where you could drop $1 in the top and 3 fell at the bottom over the next 6 or 9 months, and you put those 3 in and you run it through again, and you pay me back $1.30, then all of a sudden the capital you get from Tractor is the cheapest capital you're ever going to get, because you know what the ROI is, and you're retaining all the upside of that revenue growth over the next couple of years. So it's really important to think about the job to be done with that dollar. I would strongly suggest against using our money to go and hire 10 software developers to build a product that won't be in market for us. That's an expensive way of doing things. That's when you need your capital partners to come in and take a risk that this may not do what you think it's going to do in the long run. So there's one other important part. The revenue-based financing is non-dilutive. It does not touch your cap table. There is no percentages attached to it. I don't care about your valuation. It doesn't worry me. All I care about is whether my credit and risk team believe that you'll continue to grow your company and you'll pay our loan back over a couple of years. We do have, sitting next to it, however, our team of exited founders and 70 shareholders who are all highly incentivized to help you grow your business. And that's what we use our advice for. And to do that, we earn warrants. So we earn warrants, which is our right to buy a small portion of your company at today's valuation, not for free, today's valuation. And we earn it over 12 months. As in, we throw the kitchen sink at you. We help you with a lot of operational capital advice. If you don't like us, you can fire us. And they stop vesting. So they vest across 12 months. So when people come with equity, they buy the shares in your company, and whether they help you or not, they own them. We earn the right to buy some shares over the next 10 years at today's price. We may not do it, and we generally only do it if you sold the company. We'd buy them on one day and sell them next. That's what would happen. We certainly don't use them to there's no influence or control or anything. It's just an option to buy some shares at today's price if you sell them in the future. And hopefully we've actually helped you grow the business as well. So that's kind of the mechanics of how we do what we do and why we do what we do. I'd love for anyone who has any questions to pipe up, because it's a little bit different and there's a lot to take in.
Thank you so much, Matt, for that quick synopsis. In the poll that I launched with the group today, I was asking, at what stage are you in? Pretty much everyone is looking to cap raise or currently going through a cap raise. So this is a really great information. And can you tell us a bit about the event on tonight in Melbourne before we get into questions?
Sure. Yes, it is called The Cost of Capital, which is we're on a bit of a tour. Gaz, our marketing guy, used to run tours for bands, so we're literally on tour. And I've got there's 18 people in my team, so there's different people doing different things. So tonight we actually have our Kiwis, who are my founding team members, who the rest of my team haven't met until yesterday. So it's an exciting time at Tractor because we're all in one spot, or most of us are in one spot at the moment. So it's at the Commons in Cremorne, and if I do this and then do this, I can put the link in the chat, which I'll do in a second. Here we go. Copy, paste. By all means, come along, and they're all over the place. We're literally all over the country. So one thing I was going to talk about, which I didn't quite get there, but let's do it right now, is like, when is the best time to use Tractor? It's kind of three different use cases that might make sense to you as a founder. You don't have any external investors. You're bootstrapped, right? You've created something out of your own steam. You've funded it externally. You've funded it internally, whether it be from customer revenue, from a services businesses, whatever you want, and you just don't have any other shareholders, and you like it that way. Great. We're happy to help. So the minimum entry point, sort of 15 grand a month in recurring revenue, is kind of the minimum we start at. But most of our companies are doing hundreds of thousands of dollars a month, and the important thing about the monthly revenue is that the amount we can loan you is a multiple of monthly revenue, somewhere between 2 and 4, depending on how fast you're growing. The faster you grow, the more likely we can lend a little bit more, because we're more confident that it'll be able to come back at the right amount of time. So use case one is you're bootstrapped. I'm going to do this whole damn thing myself. I would like some capital. I might like some advice, but it's all mine. I don't need shareholders. Great. Happy to help. The second one is you are externally backed and things are going well, so you're not about to run out of money, and you've kind of got that growth engine working. Like you've got to the point where that the way I describe these things for founders is you're at the helm of your business and you've got all these levers you can pull, and you're probably constrained, so you're pulling them a little bit, and you can see the revenue sort of go up a little bit. You're like, I need to give these levers now, are ready to give them a big pull, and I think it's going to drive the revenue quite quickly. And we might need to raise in the future, but I'd really like to drive some more revenue through it and drive our MRR, ARR up. So before you're running out of money, before you're about to hit any walls, give us a call, because we're going to put this in and drive top line revenue. So when you do go to raise money, your ARR is higher, therefore your valuation is higher. Therefore, you can either raise less money or raise the same amount of money for less dilution. That's the way you can do it. But the two things we don't do is we don't take VC risk, and we don't rescue anybody. So we're not the lender of last resort. If you call something, I've got 2 months worth of runway left and I'm fucked, I'm like, I can't help you. I'm sorry. It's just not what we do. We make tractors go faster, or tractors turn into rockets. We don't save them from driving off a cliff. Like, that's just not what we can do. We're a lender. We're not a VC. So, we expect 95% plus of our money to come back to us, plus our interest, as opposed to a VC that expects 8 out of 10 of the companies to go to zero and get nothing back. Like, that is not how we work. We're a lender. We're not an investor. We're a lender. We're not a VC. So just to be really clear about that. So the second use case is we are externally backed. We've got angels. We've got VC, whatever. Things are working well. We've got our growth engine kind of working quite well. I can drop $1 in and more than my dollar, I don't know, 30 or 40 fall out the bottom, in a reasonable amount of time, and I stick it back in the top again. So you sort of have this effect, and it's kind of working quite well. So you can drive your growth. And the third one is we are VC backed. We've got a round away right now. We're raising, I don't know, a couple $1 million. But we also have that machine running. So again, it's got to have revenue flowing through it. It can't be for non-revenue generating companies. That's not what we do. And if you're raising a couple $1 million and you've got a decent enough revenue, we might be able to lend you a quarter of that round or a chunk of that money. So you take the same amount of capital in, but you sell fewer shares, which means you dilute less, which means you retain that value going forwards, on the assumption your company can sustain our loan, which are all the work we do up front, which happens pretty quickly. Happens over the space of a week or so. It's not a long process. Is we understand the mechanics of your business. We take your forecast into account. We apply some modeling to it, and we come up with a couple of numbers, which is how much, what's the factor? So 1 point something, and that's kind of what you need to know. And we would have sort of made it sort of come back over a couple of years based on your forecast with our modeling applied to it. So there's kind of 3 general use cases you would have when it comes to why you might want to use this type of capital.
Oh, and Mick has his hand up. I was also going to ask you, Matt, for how many months in a row do you need to meet that sort of minimum threshold of 15K revenue? Could it be that, woohoo, we've hit it, I'm going to go talk to Matt? Or what's the, is it 6 months of 15K at least?
Not necessarily. Like it is a combination of numbers and growth. And a lot of the work we do to understand these businesses is getting comfortable. We need to get comfortable that growth is not a once-off thing that's going to go back down to zero again. It's actually going to be something that's kind of, the mechanics are there. So a lot of what we talk about is a lot of the work we do is talking about working with the founders to understand the quality of that revenue. So is it a once-off thing? Did we accidentally stumble on it, but we can't sustain it? Things like that are the type of questions that we will have around you, which, as a founder, I like answering those questions. Like I like it when people go, actually, so tell me what you did, what happened, can we do it more? Is it sustainable? Some of these things do create spikes, which sort of flatten out after a while. And it's just sort of understanding that, which as a founder, as I said, I want to have those conversations with people because I want to understand it too. So the answer is, if that growth is happening and the mechanics, you kind of stumbled upon, or you've purposely found the point where you know what's happening, then that's a great time. Or even if it's starting to happen, like that's start that conversation. So when we get there, we can do something. And the reason we say 15 grand is because it's likely to be a $50,000 loan. So we need to make it. It takes the same amount of effort for us to write $1 million loan as it does to write a $50,000 loan. So we just need to make sure that we spending our time wisely with founders who actually, like, 50 grand may not make a difference, but I've got people doing small amounts of revenue that are cash flow neutral, and a 50 grand loan actually is absolutely meaningful for them because they're heading into profitable territory, pumping it back into the business, watching their growth grow, and they're so excited because they've got no one to answer to, and they're just all of a sudden being able to sort of grow the business. Because this has been able to allow them to invest in some of those mechanics that allow them to go a bit quicker.
Matt, that's what I was going to dive into. Thanks for covering all this. Amazing to have experienced entrepreneurs who have alternate capital options when we had none back in the day. So really good to see. I think certainly for first-time entrepreneurs, what can be really frustrating is risk taking. Check to a small VC saying all you need is 10 customers and $1 million revenue for me to write you a check. And it often seems like if I had $1 million revenue and 10 customers, I wouldn't need your money. To your point, like getting 50K, and let's say if it's a bit more, I'm a bit more progressed. Do you have maybe perhaps some examples of what do companies do with it? You mentioned sort of roughly what they might spend it on, but I'm going along, it's going quite well. I'm in a pretty good space, more money coming out the top. You mentioned so getting an extra 50 to 250K, like what do some companies do with it, which might give people a sense of how that actually helps them grow?
Yeah, look, it's things that sort of have an ROI that you can sort of know will happen. Like there's kind of a dip and then a growth, like you invest in the thing and the thing starts to yield. So it's usually like sales and marketing. It could be salespeople. Like it could be like, I've now got to the point where we've got leads coming in and I need to actually get them through the funnel properly, where, it's almost the best way to think about it is variable costs. And the things when we say variable costs in business are the things that they kind of float up and down with the revenue. Like a software developer is generally a fixed cost. You know, they cost you 200 grand a year FTE, and that's kind of it. And they do things that generate revenue, but it's not a correlation between the work they do and an immediate impact. We're sales, marketing, you know, buying customers. So if you've got your CAC, LTV, and ROI stuff dialed in well, and you can actually buy a customer, and you know that, you know, the LTV, you know, the payback period is within a certain zone, then, you know, if I just had more money, I know that I'll acquire customers for X per customer. And, you know, I charge them, you know, I can buy them for 100, you know, I can buy them for $100. I charge them $20 a month. 6 months later, I'm in the black. Let's buy a shitload of customers, right? And then, you know, we get paid back, and you'll be growing, you know, your revenue then would grow quickly. We'd pay, you know, whatever, 5-7%, whatever the case may be. But you'd have this sort of massive influx in customers if you got that mechanic right. The challenge, of course, is those things aren't consistent. You know, your CAC varies over time because you saturate a channel, or the competition goes, holy shit, there's cheap customers over there, I'm going to go throw money at it too, and all the floor comes up. So to answer your question, Mick, it's those things that you kind of have a fairly good handle on what the cycle of returns is on. And it's you know, we speak about risk, you know, and I think one of the biggest tricks the VCs have played is you know, they'll keep asking you to sell them shares all day long, when the risk is actually at a certain point, the risk is actually mitigated to a point where that asset that is that revenue can be leveraged to grow the business, and the risk is almost diminished down to almost nothing. But they're happy to buy 5 to 20% of your shares all day long. Whereas a founder, you're like, hang on a minute, like I've got this thing here that's working. I need to grow it more. I'm confident that my revenue and my confidence have crossed over where I want to double down on it, and I want to back myself rather than asking someone to sort of hive off that value for them and allow that capital. And it's a challenge, because here's the challenge is, if you've built something very exciting, there's probably going to be an unorderly, if you get it right, there'll be an unorderly queue of people wanting to buy shares off you. And as a founder, that is the exact time you need to go take a breath, take a deep breath. If this thing is as good as everyone says it is, and I've got a shitload of revenue, maybe I should leverage some of that to not sell as many shares or fewer shares, so that, you know, I can blend it together. And entrepreneurs, tech entrepreneurs up until now, relatively now, haven't had the choice. Like when Mick was starting his businesses, no one would lend him a buck, no one lent him any money, right? So it's like, I have to sell shares, it's the only way. And now, you know, we believe that a blended capital stack, which is the combination of equity and share and debt, is the way you should build a company. You know, no other businesses, tech businesses, flog 20% of their company every time they need some money. You don't go, your local cafe is not selling shares to buy a coffee machine. They're leasing the coffee machine and funding the parts of their business differently. And only now tech companies have the ability to think about the different parts of their business and think about funding them differently. But let's be clear, if you've created a great business, there's going to be people who want to buy those shares off because they know where it's going and they want a piece of it, and they want a piece of it today because it's the cheapest it's ever going to be. So as a founder, if you do manage to get yourself in that position, just take a deep breath, speak to Mick, speak to your mentors and say, like, what is the smartest way of doing this? Because I don't want to hand over all the future value of these shares to everybody just because they desperately want to buy them. It's a nice scenario to be in, but if you get it right, you'll be there, I promise.
That's some really good advice, Matt. We have had founders come to that position of like, wait a sec, maybe I should take a breath, and we have connected to them with mentors. So if you are in that position, just reach out on Slack or an email, and I can connect you with some amazing mentors, or even, you know, hook up a chat with Matt Allen as well. When you are sector agnostic for Tractor Ventures, but heavily focused on tech, because we view climate tech as using technology to scale climate solutions as well as adaptation and resilience. So I'm just looking on the line here, like Darcy Small has Cure Coffee, which is a carbon neutral social impact coffee, but it's, you know, enabled with the technology they use. So what is your definition, I guess, of that tech? Is it SaaS?
Yeah, we also, not necessarily. So we also talk about tech enabled. So like I think I mentioned earlier, I'd like businesses that are able to scale, right, via a product rather than a service. So it feels like coffee is a product, I assume, you know, and it could be a subscription thing, for instance, or it may not be. We're actually quite flexible. So one of the use cases we have often is people that have started their businesses in the service business have created a product or a recurring revenue stream within that business, and they want to double down on that. They basically want to flip from selling their time and materials into selling the product. So you've sort of got this, they might have a top line revenue for the whole business like this, but the services part is sort of coming up over time. And they're like, if I was able to stop doing the services and put those people, those resources into the product thing, I think we could turn it into a complete product business. So that's interesting because VCs will discount any service, anything that requires like a one-to-one correlation with the time and material. Just like, we don't value that at all. You need to shut that thing down, and you need to just put a bullet in his head and turn it off. Which is because what they want to do is because they want to buy some shares to get the product thing scaling. So that's where you unlock the potential growth. So that's an interesting one. Like, we will take all of your revenue account as long as there's a component of it that you want to grow, that is growing, and you want to continue to grow, that's got that uncoupled nature to it. Does that answer the question, Charlotte?
Absolutely. So thank you for that. No, I guess because we're a climate tech network, and it seems that it's the sector that most investment, dare I say, VCs are excited about. Is there a sector that you're really excited about, or can you truly put the lens on and just look at it because you're assessing startups, scale-ups on that revenue? Yeah,
it's funny. We don't. So a lot of my team come from another large SME lender, which is great because I don't have to start from first principles. But when they think about like cohorts of customers, they think about like hairdressers and coffee shops and da-da-da. Like, we actually think about like what type of selling they do. Like, so we've got enterprise SaaS, we've got SME SaaS, we've got D2C, we've got e-commerce, so it's not what you do, it's the method you do it is kind of how we cluster our businesses together. So I think I was just in my exec leadership team, I think we have 7 different types of businesses inside our 30 odd companies. So we don't have a lot of data density yet, but it is getting there. We do love quality revenue, which is our nebulous term of figuring out, if it's enterprise, is it contracted? Is the likelihood of it continuing to do what it is? If it's not contracted, but there's a shitload of customers, so lacking customer concentration is important. I remember when Atlassian went public on the NASDAQ, their single biggest customer paid them 5% of their total revenue. And it was a heavy cliff after that. It just had this long tail that went for 7 kilometers that way of people paying them nothing, right? So that just, that for us makes it feel like you got quite a resilient business because the likelihood of them all disappearing overnight is quite low. And that's the kind of things we're looking at as the type of businesses that we're like, cool, again, back to the point of, we really need you to return this money in our interest over the next couple of years. So therefore, if you've got one customer and they decide to change their mind, like, you're screwed, which means we're screwed. Like, that's hard for us to get our heads around.
I think go Darcy, jump in, mate.
Oh, thanks, Mick, and thanks, Charlotte, for asking that question on my behalf earlier. I had it in mind, but Matt, if people are approaching you as part of a VC round and wanting to cover 10 to 20% of that round with debt, is that from your perspective more exciting or less exciting, or more do you look into the way the VCs have valued and structured that deal as part of your work as well?
Yeah, our whole team is venture people, by default. They've been through hyper growth stuff. So the warrants part, that advice seems really interesting then. So again, we want to make sure you are saving dilution. So we want to make sure that if we're going to get those warrants, they are tiny relative to the whole round, So there's a little bit of a balance there where it's like the capital, if you take the advice is optional. You don't have to, but the vast majority of people do, because to get 70 people from those companies are on the other slide on call for you to help is invaluable most of the time, and worth it. I think, Mick testament that plenty of VCs will say they're helpful, but they're pretty limited a lot of the time, and they don't have to help because they want to, but they're constrained. we've actually got the mechanism to scale that up. So that's interesting. So, you know, a bank lends you money and all they want is, their definition of success is you pay your money back on time, right? A VC takes a chunk of your company, their definition of success is you become Canva or Atlassian. We lend you money, but take a small upside, unlimited upside position, or earn a small unlimited position as well. So it's a blend, but our credit guys and our loan guys and our portfolio team that do all the help are actually independent of each other. So they'll have the conversation in parallel. And I imagine that if you know, if a large VC was putting a round together and you invited us in to save a little bit of dilution and, you know, squish them down a little bit, you still took the same amount of capital, took some more with us. You know, we would be excited about that. And it's happened a few times. And it will happen more now, especially because the valuations are going down, which means the same amount of capital is taking more dilution, which means everyone's dilution sensitive, which means all of a sudden, when people are saying, oh, I'll just take this VC money because it's only diluting me 4% and all it's taking 20%. They're like, oh, that's really not as much fun as it was 6 months ago. So all of a sudden people are super sensitive. The irony is, of course, is my cost of capital hasn't changed one iota. Everyone else's has gone through the roof. And, you know, if ours costs you 20s, you know, low 20s as an annual percentage rate, and that's still costing you 50 to 100, or if it's in it really early, it's like 200% is what they expect on their capital they gave you as a valuation at the end. It's really quite, the delta's quite large, but your business has to sustain it. And, you know, we say that with revenue-based finance, your business pays for it, and you as the founder or your shareholders retain the value. You know, with equity, you pay for it, and all the value is handed over to the shareholders, right? But, you know, there's a risk element involved. You know, to give you a really good example, a really good friend of mine, Rain Ong, who you've probably heard of, he's a bit of a super angel. You know, him and I sort of go toe to toe. He's got Sydney, I got Melbourne. I was talking to him this morning. So he had a return for a return on one of his companies lately, and his IRR, his internal rate of return, was 66% over 8 years. So that's what happens when you get in early. So, like, had he put that money in the bank, they would have had an annual interest rate of 66% or thereabouts for him to get those kind of returns. So that's the kind of thing where, you know, that capital is obviously required up front. You needed that, and then this company certainly was probably not in a position to do any kind of lending, even though it was 2010. There was no 2014. There was no available. But if it was there, you know, you'd have to make that decision nowadays where you couldn't have before.
That's a really key thing I want to drill in, and it's much easier after you go through a company or a few and see them to have a bigger understanding of the realities and costs of capital. And there are multiple costs of capital. Matt's alluded to. There's the percentage cost of capital, but there's also, as he also touched on, is the pressure cost of capital. You know, you can absolutely sense from Matt that slow growth over a period of time that you're comfortable with is what he wants, let alone what he's comfortable with, versus VCs need you to be a home run or not. They would absolutely rather you die, run out of money, than end up as a $100 million company. Right? That's a failure for them, and that's really hard to see. I think, especially when 99% of the media attention and you know, documentaries on TV is about these big capital raise, and people celebrate them. Right? It's like and I'm, you know, I can just always sense Matt going, yeah, you're celebrating giving away 20% of your company. Why are you celebrating that? So I think the understanding the different journeys, and I think one of the critical things for us is you have the thing that's really valuable. You've got the company that everybody wants, and it's going to be successful. There's definitely risk in it, but you get to choose the path you want to go and create, and owning the whole company and having a great team around you and selling it for 100 million without any pressure and stress, and being able to have holidays and take some equity and take some money off the table when you need to, versus raising big money and having a media release on AFR. Like, it's very hard, I think, early when you've got so much risk ahead of you and you need the money, and you got that pressure to get that feeling. But like, how do you, Matt, how do you help people like contemplate that journey in advance if it's their first time?
Yeah, look, it's hard for first-time founders. You know, a lot of our companies have, you know, the one thing that has been really interesting is like when I started Tractor, and I spoke to Nick about this, you know, wherever we were, I think we were in New Zealand or somewhere. I can't remember where we were. Or was it San Francisco? I can't remember, but it was like
San Francisco. Yeah.
You know, I've got this thesis that you know, time is kind of your friend if your capital is aligned to it. And you know, like let's be really, really clear about this. Is that like VC is a business model. Like your business model and their business model are tightly coupled the minute you take their money. And time is not their friend, right? Like time is not your friend because they've got a fund that has a government mandated end to it. It's like they'll literally call you up one day and like, got to sell my shares. You're like, the fuck, what do you mean? I'm not finished. They're like, too bad, I need to sell my shares. And that's a real pain in the ass. You know, there's mechanisms to do it, but it's not easy. So, you know, I can give you a story of a company that I helped found with my mates. It's called Billkind. They deploy software for other software developers, so super nerdy dev tools. We put a couple of $100,000 into those guys at a $2 million valuation, so less than 10% of the company. So it was over 2.2 million, so 9.7% of the company. That was the only money they took, and they compounded it like 7.5% month-on-month growth for 75 months in a row. Lived within their means, covered their costs after about 12 months, and then continued to grow. And then they sold $5 or $6 million each at a $200 million valuation because they'd just grown this amazing business, and there was no pressure on them to do anything besides have delighted, happy customers that didn't leave. Like that is the way you build an actual business. Now, you know, the pressure we put on ourselves to go faster than you would naturally do it's you know, it's tough. We really kind of give ourselves some shit here. But you know, even as Tractor, like I expected Tractor to be a pretty small business, and I think when I spoke to Nick, I'm like, oh, I might be able to do 6 or 7 loans, you know, a year, and it'll be a nice little thing. It turns out that it's a really fast growing business, not because my capital told me to go fast, but because I've built a product that people want, you know, and that I'm getting pulled rather than getting shoved. And you know, you don't know that until you're out in market. So all I can say is if you're thinking about doing this stuff, you know, and Nick will tell you, focus on something really small, get the job done, start that feedback. If you can get 1 customer, you get 2, you can get 4, you can get 8. And I think that, you know, turning the revenue on early is if you're not turning revenue on, is usually because your ego's stopping you from doing it, right? Like you might be afraid that they'll say no. The quicker you get a no is the quicker you can go find something else to do. You know, and it could be just something next to what you're doing, or it could be something completely different. You have to shut it down. But, you know, going, oh, I'll figure out that later is not the way to build, especially attractive business. You know, these ones of like, I'm solving a problem. I'm happy to charge for it. I'm happy to charge a lot for it if need be, even if it's niche, because it's solving a real problem. And it's not everything to everybody, but it's certainly everything to these people when they really need it. And I think that's you know, if you can get into that thing quickly, then it'll pay off. You just got to wait a while.
We probably have time for just a few more questions, but is it should we change the narrative then? So rather than celebrating the green unicorns in climate tech, we should be celebrating the green electric powered tractors.
There's some awesome electric tractor companies out there that I'm following along on. I believe that our old mate Mike Cannon Brooks has got all electric vehicles on his farm down in Barrel. Yeah, everything you know, runs off electricity down there, which is pretty cool.
Yeah, I think a green tractor. So yeah, Accuracy, I think we've got at least one company now in our group that's a member. And again, it's not for everyone, and that's okay. And neither is venture capital. And both of them actually rely on you making a product that customers want to buy for a fair profit exchange. Like I think there's just way too much hype in all of startups around capital raising and listing on the stock exchange. They're pretty fundamental at the end of the day. It's exactly as Matt said, and I think that is a reality check, and the fact that you can have options. But it all definitely comes down to your ability to go and build a team that can build a product within that realms. And there is pressure on climate because we've got climate problems, and you might say I've got to go faster because of that. I get a sense around that. Like it's, you know, if build kite grows nice and slowly over, like the world's not going to fall apart. But you know, we might think that in terms of climate, but also if you don't build a sustainable business, we also don't have the impact. And one of the things I've loved as an entrepreneur is the confidence you have walking into an investor when you've got a business that's organically grown. Because if they say no, you go, I guess I'll just keep growing then. Like it's a pretty good fallback to have versus, you know, I'm running out of money. And again, not everyone has that opportunity, but you know, I think people, the numbers are so bad. If you actually look to them, the numbers of companies that actually raise, and people think, oh, I've done a Series A, I'm done. Less than 15% of companies that do an A do a B. So if you think, wow, it's all done, like 85% of them don't go to the next level. Like you still have to then go create a business.
Yep.
And you look at like fast.com, they raised a ton of money, and obviously there were no happy customers paying the bills. So I think it's just a really good, like, honestly, even if you end up raising capital from VCs, just think, if you thought that you were going to pitch to Matt instead of VCs, my guess is you get a better response from VCs. So anyway,
it's interesting because I think, you know, a lot of capital can smooth over a lot of problems. Like you can just hack around them by hiring people, by doing whatever and going, you know, it's working, kind of. But I think capital constraints sort of actually brings out a bunch of creativity a lot of the time. And, you know, Nick's seen both ends of that scale, you know, scrappy founders doing with what they've got, you know, frugality. Like the way we describe a lot of our founders is they're actually as ambitious as a venture-backed founder, but they're also got kind of equal amounts of caution and this layer of frugality under it. And one of the challenges we have quite often is we drop, you know, 300-400 grand in someone's bank account. Is they just kind of stare at it and go, you know, I feel great. I'm like, well, that's not going to really help us here, right? You've got to do something with it. But like the actual, you know, the muscle of putting it to work well is actually something which is why the advice stuff is also helpful to a lot of people. It's like, well, you know, let's think about how we actually use this to drive that revenue and to make sure that your company is sustainable, and hopefully sustainable and growing in an exciting way. But again, you know, you do you. We're okay with it. Our business model works for any of those things, you know, and we're happy to help. You know, even so, a company in our portfolio did a partial exit. Two founders took about 1.2 million off the table after 3 or 4 years. They still owned 20% of the company each, and the new sort of half owners put some money in the bank account and they're going to go off and grow it. You know, we didn't exercise our warrant, so we just left them there because we think they're going to go off and actually build a bigger business now. They've got a bit of capital and off they go. But like, you don't get that choice. Had they taken VC money, the VC is like, no, that's a shit valuation, you know. And yes, like that $1 million to you is literally life changing. You bought a house, now you're really ready to go build a big business, but it wouldn't have been approved. There's no way on earth someone with who put money into that business at even a reasonable valuation would have said yes. So, you know, and I've got a strong bias for founders that, you know, if you've got the opportunity to de-risk a little bit along the way, it does allow you to make far better business decisions in the future. It's really hard to build a big business when you've got every asset you own is that thing. So, you know, there's ways and means to do that as well along the way. But the bottom line is you need to have a business that people are excited about one or another.
A really key point that Matt made before is iterating there is alignment. And what 90% of first-time founders don't understand, because it's just not talked about, is that VCs have investors of their own, and they, as Matt said, they need to give. They're legally bound to give all of the money back. Like they have to liquidate their. There's a very few that don't, but they have to basically give it all back in 10 years' time, and then that's why they do multiple funds in a row. So you know, it changes the alignment. Like they have investors who they answer to. They're not sitting here going, cool, you're growing, whatever. Like they have to give the money back. Whereas Matt's investors are basically like, you find a good company that's just going to pay us back really great returns slowly over time, but 95% likely, that's a great outcome. So it's what we always talk about at Climate Salad is the first thing is to go and build a good company, but find investors who are partners with you. And then those partners would never give you money if they were good partners on the wrong basis or without alignment, right? So just do it slowly and start early, because then you've got more options.
You know, also you're all building impact businesses by default. You're an impact business, and to make the most impact, you've got to have a good business. Like there's not like a bad business that's going to have no impact, and you're really in hard mode then. Like it's like, shit, I've got a bad business, my Univenture, I don't make any money. Obviously the impact is usually baked into how you do stuff. But, if it doesn't hit a kind of level of scale, it's not very impactful, and you feel sad.
You certainly will. I always ask for a group selfie at the end, and Mick's going to come back for that. If there are any questions, please do. Matt, would you mind to stop sharing? And also, sure. Just so we can do the gallery shot. And Matt, you're doing a tour like a rock star across Australia and New Zealand. Tonight is Melbourne. When is Sydney, Brisbane? Hobart?
They are.
Or where can we find it?
Yeah, I'll put a link in the chat. Let me just stick it in there again. Hang on a minute. Here you go. There we go. That's everyone. Yep. So that's the whole series. So yeah, Surrey Hills on the 9th of the 6th, Gold Coast, Brisbane, Sydney, Adelaide, Auckland, Perth. It's a real actual tour.
Wow, getting to travel again. Thank you so much for enlightening us on the different pathways that founders can take. There isn't just one way to skin the climate cat, which is good to know. Terrible analogy, I know.
We need a better analogy there, Charlotte. Come on, we've got to work on a good climate analogy.
You know how I feel about cats.
Exactly.
Don't like them, sorry. So I'll just get this here. And if we,
tractor.
Nice.
Duplo.
That's awesome. Hey, there's Jez. Hey, mate.
Amazing. Thank you so much for your time, Matt. Enjoy tonight. If you are in Melbourne, do go along to join Matt. We actually have an event in Sydney on the 9th, so we might not join you at Surrey Hills. But thank you so much for coming in on board and online. I may as well stop.